Now let's detail the relative valuation process. To recap, relative valuation is when an analyst compares a company to itself, to another similar company, or to the overall market to divine relative value. You'll be relieved to hear that this process is more intuitive than absolute valuation. It is akin to a shopper in a store comparing one loaf to another to see which is the better buy. The biggest way in which relative valuation is different from absolute valuation is that it is not an effort to calculate an actual fair share price, but rather to determine whether a company is undervalued, overvalued, or fairly valued. Relative valuation is a two-step process. The first step in the process is to choose a relevant metric with which to conduct the relative valuation. The second step is to compare your favored metric to something else. A traditional yardstick of relative valuation for equities is dividend yields. Dividends are regular, steady payments to shareholders that are usually paid in cash out of company earnings. Company management teams are typically loath to cut dividend payments as many shareholders rely on them as a steady income stream when they retire. This regular flow of cash payments looks similar to fixed income, but there are two key differences between dividend yields and bond yields. First, as dividends are carved out of earnings, which are variable, dividends tend to change, whereas fixed income payments do not by definition. This variability of dividends from year to year therefore tends to make dividend yields more variable than bond yields. Second, dividend yields are easier to calculate than bond yields. Recall how bond yields were calculated using all the future bond repayments up until maturity. There is no concept of maturity for an equity. When you own a share of a company such as Johnson & Johnson, that share can give you dividends for many decades to come. So dividend yields are instead calculated using a one-year or part-year dividend payment as the basis for calculation. Let's demonstrate the first difference by looking at Coca-Cola. If we type Coca-Cola into the command line, select the company, type dividend into the command line, and then select the DVD function, we can see Coca-Cola's steadily growing stream of dividend payments over several decades. Selling sugared water has proved to be one of the most successful business ideas of all time. This is a tangible demonstration that equities, unlike most bonds, can last a very long time, and also that dividend payments, unlike ordinary bond coupons, can grow. Let's demonstrate the second difference. Dividend yields are far easier to calculate than bond yields. A dividend yield is calculated by taking the dividend per share and dividing it by the latest share price. Companies frequently pay dividends twice or 4 times per year. To ensure the comparability of dividend yields, it is standard practice to take 1 year's worth of dividends for the calculation. Let's show an example using fast food restaurant McDonald's. This screen was captured in early 2015 when McDonald's had just appointed a new CEO. The quarterly dividend was 85 cents per share. Therefore, on an annualized basis, an owner of one share would have received $3.40. As the share price was $96.29 at that time, the dividend yield was 3.53%. This meant that 3.53% of McDonald's share price was supported by annual dividend payments. This is far simpler mathematics than calculating a bond yield. Recall that shareholders own all the residual earnings of a company, not just the dividend payments. Therefore, another valuation measure that investors calculate is the earnings yield, using the earnings per share, EPS, rather than the dividend as the numerator. This typically boosts the numerator of the yield calculation, and so makes the earnings yield higher than the dividend yield. By looking at the dividend yield and earnings yield side by side, we can see that in this case, the earnings yield, 5.19%, is indeed higher than the dividend yield, 3.53%, because the estimated earnings per share, $5, is greater than the dividend per share, $3.40. The reciprocal of an earnings yield is the famous price-to-earnings, or PE ratio. Let's demonstrate by starting with the formula for earnings yield. When we divide the $96.29 share price by the $5 estimated earnings per share, it gives us a PE ratio of 19.3 times. Note, people will refer to PE ratios verbally as 19.3 times or 19.3x. In print, the standard practice is to show a PE ratio to one decimal place followed by a lowercase x. The x represents the multiplication symbol as opposed to an algebraic unknown. As PE ratios are usually greater than 1, they are referred to as PE multiples. Share price is the numerator. Earnings per share is the denominator. Given that a PE ratio is simply the reciprocal of an earnings yield, were we to plot both on the same chart, we would expect them to be mirror images. Let's demonstrate using McDonald's and the graph fundamentals, or GF function. Let's first plot earnings yield onto the chart and then overlay the PE ratio. The earnings yield is 5.19%, and the PE ratio is 19.3 times, one being the reciprocal of the other. If you look at the time series data of earnings yield and PE, you will see that they are indeed mirror images. Now you will appreciate that equity valuation, like bond valuation, is essentially based on yields, albeit disguised as ratios. Let's show how a PE ratio is calculated in practice. It is customary to use the estimated earnings per share to calculate the so-called prospective PE ratio. This is calculated by dividing the share price by the estimated earnings per share for the upcoming calendar year. Let's pull up the company description page again for McDonald's in March 2015. The share price was $96.29. The estimated earnings per share was $5. Therefore, the price-to-earnings ratio for McDonald's was 19.3 times. We could equally have divided the total market capitalization by the earnings for the whole firm. This would effectively involve multiplying both the share price, the numerator, and the earnings per share, the denominator, by the number of shares. And when you multiply both the numerator and denominator of a fraction by the same number, you end up with the same fraction. PE ratios are the mainstay of relative equity valuation. Let's show how they are used in practice. Recall from the Delta Airlines example how analysts estimate earnings. If you have an earnings estimate and you have a sense for a fair PE ratio to apply to that earnings estimate, then equity valuation is a piece of cake. You simply multiply the earnings by the PE ratio. The E's then cancel one another out, leaving you with the P. Say you felt that better burger joints were going to take market share from McDonald's. You may estimate that McDonald's earnings would decline from $4.8 billion to $4 billion, and the P/E ratio would decline from 19.3 times to 10 times. The market cap in this scenario would be $40 billion. With 1 billion shares, this translates to a $40 price per share, compared to $96 at the outset. This framework gives you the two reasons that share prices may go up. 1. If the P/E ratio stays the same and the E goes up, the P will go up. This is when earnings growth drives the share price. 2. If the E stays the same but the P/E goes up, the P will go up. This is when so-called multiple expansion drives the share price. While the mathematics is simple, both the guesses of earnings and of a reasonable P/E ratio are fiercely hard to generate. Looking at the E, we already saw how fiendishly difficult it is to arrive at defensible assumptions about future company performance. And remember, too, that estimating earnings is not done once at a point in time. The economy moves on, competition doesn't stand still, technology evolves, and with them, assumptions and consensus earnings evolve, as we saw with Facebook revenue estimates. Estimating P/E hinges on one's belief in growth of the E. A company can grow into a high P/E ratio. Strong growth in E can therefore warrant a high P/E. Let's show how. Take Apple in 2003. The iPod music player was off to a strong start. With the luxury of hindsight, we now know that Apple's earnings were about to explode for the next 12 years until they plateaued in 2015. Had you foreseen all of Steve Jobs' planned gadgets, such as the iPhone and iPad, you would have found it attractive to own that growing stream of earnings. Accordingly, you would have paid more for each dollar of earnings at that point than you would have for the earnings of a stagnant company. To put it a different way, you would have awarded Apple with a high P/E ratio. Why? Let's bring up a chart of Apple's E, P/E, and P, that's the market cap, over this 12-year period of explosive growth in earnings. Remember, earnings multiplied by P/E ratio equals market cap. So, for instance, when Apple's earnings plateaued, Apple's $40 billion of earnings multiplied by 16.8 times P/E ratio equaled Apple's $672 billion market capitalization in early 2015. In 2003, we can see that Apple's P/E ratio peaked at 160 times. Apple's earnings skyrocketed from 2003 and then plateaued in 2015. Over this period, the P/E declined to the mid-teens. The 160 times P/E in 2003 was more than warranted by the subsequent earnings growth. The E grew more rapidly than the P/E declined. Therefore, Apple's share price went through the roof. While it may not have been apparent at the time, the 160 times P/E in 2003 was a bargain. Rapidly growing companies can grow into very high P/E ratios. Do not assume that high P/E ratios automatically make the stock expensive. To summarize, when valuing a company, estimating earnings is hard. Estimating the P/E ratio is also tricky. These estimates are particularly difficult when a company is going through a rapid growth phase. Even mature companies can go through unpredictable cycles of so-called multiple expansion when the P/E ratio goes up and multiple contraction when the P/E ratio goes down. Now that we know some of the typical metrics used for relative valuation, let's demonstrate how they are applied in practice. In simple terms, an investor will compare his favored metric to one of three things to gauge relative value. 1. That same metric over history. How has the company's metric trended over time? 2. That same metric for similar companies. How does the company's metric compare to the average of its peer group? 3. The same metric for the overall market. How does the company's metric compare to that of the market? Imagine once more that it is March 2015. An investor has taken note of several new fast food chains and the movement away from established fast food brands. He is a little skeptical of the durability of several of the new chains and believes that at some point consumers will start going to McDonald's again. Accordingly, he wants to do a relative valuation of McDonald's using its PE to determine whether he should buy the shares. He begins by comparing McDonald's to itself, looking at the historic level of its PE ratio. First of all, he pulls up the share price of McDonald's since the financial crisis of 2008. He sees that the shares rose from $60 to $96. What happened to the PE ratio? He may guess that it went up because the P went up, but he doesn't really know unless he knows what happened to the E. If the E went up more than the PE may very well have gone down. To get smarter on the PE, he types PE bands into the command line and selects the PE bands and valuation function. The white line is the McDonald's share price. The colored lines show the levels of certain PE ratios over time. For example, the pink line at the top shows where McDonald's share price would have been over the years had it had a 19 times PE ratio for the duration. It is a step function because it takes the full year's earnings per share and multiplies it by 19. If he compares McDonald's share price, the white line, to these colored PE bands, he sees that the PE was around 18 times at the start of 2008, went below 15 times in 2009, went above 19 times in 2012, and ended at around 19 times. Now he can appreciate that share prices alone do not give a full picture of valuation. Just because shares go up or down does not make them expensive or cheap per se. One always needs to look at PE multiples in the context of earnings. After looking at hypothetical PE ratios of McDonald's, he turns to the GF function to show how the actual PE ratio trended over a very long time. Then he layers on the earnings and the share price. The earnings went up steeply from the early 2000s while the PE stayed the same. This explains why the shares went up sixfold. If the PE remains stable, as it has done over many years, and the recent dip in earnings reverses as people buy burgers again, then a resurgence in McDonald's earnings will lead to a rise in McDonald's share price. If this hypothesis on the faddish nature of the fast food industry is correct, and McDonald's reignites earnings growth, then McDonald's is a buy. To do so, he gauges where the PE ratio and growth rates are compared to its peer group. He will measure the premium or discount to the peer group average PE ratio. This is a very common technique and is what people classically understand by relative valuation. The artistry of peer group valuation comes in the selection of which companies are truly peers. Investors commonly choose peers that operate in the same industry and region, ideally direct competitors. For example, an investor in Tiffany would look at other publicly traded jewelers such as Signet, which runs the Zales, Kay Jewelers, and Ernest Jones brands, while an investor in Coca-Cola would look at arch-rival Pepsi. This is because direct competitors face the same environment and risks. If one has a much lower PE than the other, it may pique the investor's interest. One snag of peer group selection is that a peer company may be part of a conglomerate which operates in many industries. Good luck comparing the valuations of Rolls-Royce and GE's aircraft engine businesses. The Rolls-Royce and GE groups have only one PE ratio each. There are not separate PE ratios for the train business, the aircraft engine business, and the medical device business. Another snag is if the arch rival to the company being studied is private. If a company is private, it doesn't have a share price, and if it doesn't have a share price, it doesn't have a PE multiple. Most will agree that McDonald's closest competitor is Burger King. Burger King was unfortunately privately owned at the time the investor was conducting the relative valuation, depriving him of the best commercial peer to McDonald's. Let's discuss how he goes about the process of finding other peers to McDonald's and conducting this part of the relative valuation. He selects McDonald's and types relative valuation into the command line. The RV function suggests relevant peers, including fast food joints Wendy's, Jack in the Box, and Chipotle Mexican Grill. This is called a table of comparables, known to bankers as a comps table. When investors spread the comps and generate the table, it provides valuation insights. Here he can see the consensus earnings growth in the Bloomberg estimated EPS growth column. And next to it, he can see the PE ratios. He uses these two columns in tandem to gauge the fairness of the valuation. Remember Apple in 2003? If the E is set to explode, this would warrant a higher PE ratio. In early 2015, he sees that the company expected to grow the fastest in this peer group is highly popular burrito chain Chipotle Mexican Grill, with 22% expected earnings growth. It also happens to have the highest multiple of the peer group at 45.9 times earnings. Meanwhile, McDonald's, unlike most of its peers, is not expected to grow at all as people are turning their backs on burgers. It also just so happens to have the lowest multiple of the peer group at 19.3 times earnings. McDonald's low PE ratio seems warranted by its sluggish growth. Relative valuation is more intuitive if one visualizes the data. The investor types relative valuation correlation into the command line and selects the RVC function. This creates a bubble chart plotting the expected sales growth of the peers on the x-axis against their PE ratios on the y-axis. The bubble size is proportional to the market cap of each peer, while the pink bubble plots the average sales growth, PE, and market cap for the whole peer group. The blue bubble is McDonald's. Given the trends in consumer preferences, McDonald's revenue is expected to shrink 5%, while the peer group is on average expected to grow 7%. This may be why McDonald's has a 19.3 times PE ratio, while the peer group has an average of 26 times. Chipotle is in the top right with expected revenue growth of almost 17% and a PE ratio of 45.9 times. McDonald's has a low PE multiple given low growth expectations. As for Chipotle, it needs to deliver that sizzling revenue growth to justify the multiple. If McDonald's is able to become popular with consumers again, it is very attractively priced.